quiet on the set, please. If you're going to be talking in the back, you guys need to whisper. Okay, Ken? Okay, and go. And speak up really loud, too.
So I had chapter 5, question 12, and basically it starts off saying, the current spot exchange rate is $1.95 per pound, and a 3-month forward rate is $1.90 per pound. Based on your analysis of the exchange rate, you are pretty confident that the spot exchange rate will be $1.92 a pound in 3 months. Assume that you would like to buy or sell 1 million pounds. So question A is, what actions do you need to take to speculate in the forward market, and what is the expected dollar profit from the speculation? So for the solution, it says, if you believe the spot exchange rate will be $1.92 per pound in 3 months, you should buy 1 million pounds forward for $1.90, and then your expected profit will be $20,000 as you multiply the 1 million pounds by the difference of $1.92 and $1.90. For question B, it asks, what would be your speculative profit in dollar terms if the spot exchange rate actually turns out to be $1.86 per pound? So solution is, if the spot exchange rate actually turns out to be $1.86 per pound in 3 months, your loss from the long position will be minus $40,000 because of when you multiply 1 million pounds times the difference between $1.86 and $1.90, that will be your expected loss.
Also doing chapter 5, question number 8, and it's asking for the exchange rates of the Swiss franc and the Australian dollar. And the bid is the Swiss franc divided by the Australian, and the ask is the reciprocal of that. And the quote is 0.926 and 0.9271. And that's it.
I got the mini case. Mexico's payments problem. So here's like the prompt. Recently, Mexico experienced large-scale trade deficits, depletion of foreign reserve holdings, and a major currency devaluation in December 1994, followed by the decision to freely float the peso. These events also brought about a severe recession and higher unemployment in Mexico. Since the devaluation, however, the trade balance has improved. And then it asks a couple questions referring to like the balance of payments and the exchange rate. And so the analysis. So despite the fact that Mexico has experienced like continuous trade deficits until December 1994, when they made that change, when they did the devaluation, the country's currency was not allowed to depreciate for political reasons. So the Mexican government did not want the peso devaluation before the election in 1994. So if the peso had been allowed to gradually depreciate against the major currencies, the peso crisis would have been prevented. So like it was just, the crisis was created because it was like it wasn't natural. It was just people like changing it overnight. And so the key lessons are that like Mexico depended too much on short-term foreign portfolio capital, which is like easily taken back, and for its economic growth. And the country should have saved more domestically and depended on long-term foreign capital. And yeah, so if investors had known that Mexico was experiencing serious trade deficits, then rapid depletion of foreign exchange reserves, the peso might have been gradually depreciating rather than suddenly collapsing. So it would have, if they had been more transparent, it could have prevented the crisis. So that's a good lesson for other countries to be transparent about their monetary status. And third, it's important to safeguard the world financial system from like a similar crisis. So multinational safety nets should be in place to prevent these at an early stage.
Kent and I did chapter 5, question 13, and there's 2 parts to this. Omni Advisors is an international pension fund manager that plans to sell equities in the CHF, which is a Swiss franc, and purchase an equivalent amount of equities in South African rands, which is the ZAR. Omni will realize net proceeds of 3 million CHF at the end of 30 days and wants to eliminate the risk that the ZAR will appreciate relative to the CHF during the 30-day period. This is the exchange rates. So question A asks, describe the currency transaction that Omni should undertake to eliminate currency risk over the next 30 days. So to just eliminate the currency risk, Omni should sell a 30-day forward CHF against the 30-day forward ZAR delivery, which means just they're selling the 30-day Swiss franc against the US dollar, and they're going to buy a 30-day ZAR, which is the South African rand, against the US dollar. And then question B asks to calculate the following. The CHF ZAR cross-currency rate Omni would use to evaluate the Swiss equity portfolio, and then the currency value of the Omni Swiss equity portfolio in ZAR, and then finally the annualized forward premium or discount at which the ZAR is trading versus the CHF.
So for B, you would take the 30-day forward CHF bid rate, which is, the ask rate, 1.5285, which is equal to $1. And then you would take the 30-day forward ZAR rate, which is 6.2538, which is equal to $1. And then you would divide the two, 1.5285 CHF divided by 6.2538 ZAR, which gives you the rate of 0.2444114. And then the next part, the currency value at the time of execution of the forward contracts, the value of a $3 million CHF equity portfolio would be 3 million CHF divided by the rate you found previously, which is 2.44114, and it'll give you approximately a little over 12 million ZARs. And then to calculate the annualized forward premium, or the discount of the ZAR against the CHF, you would take the spot rate of 1.5343 CHF divided by 6.2681 ZAR, which gives you the rate of around the same, about 0.2449. 30-day forward ask rate equation would be 1.5285 CHF divided by 6.25 ZAR, which gives you a very similar rate also of 2.4411. And then the formula for the premium is the forward rate minus the spot rate divided by the spot rate times 360 divided by how long the contract is. And then you can just see the numbers are all very similar, and then that discount rate comes out to negative 1.8% from ZAR to CHF.
Thanks, Ken.
Chapter 6, number 3, which asks to explain the conditions under which the forward exchange rate will be an unbiased predictor of the future spot exchange rate. So there's only two conditions for that, and it's when, first, if the forward risk premium is insignificant, and the second condition that has to be true is if the foreign exchange markets are informationally efficient.
Chapter 5, number 3 is asking who are the market participants in the foreign exchange market, and it can be categorized into 5 groups: international banks, bank customers, non-bank dealers, foreign exchange brokers, and central banks. So starting with international banks, these provide the core of the financial market. There's approximately 100 to 200 banks worldwide that make a market in foreign exchange. These international banks serve their retail clients, the bank customers, which is the second market participant, in conducting foreign commerce or making international investment in financial assets that require foreign exchange. Non-bank dealers is the third market participant, and they're large non-bank financial institutions such as investment banks, mutual funds, hedge funds, whose size and frequency of trades make it cost efficient to establish their own dealing rooms to trade directly in the interbank market for their foreign exchange needs. And the fourth one is foreign exchange brokers. They match dealer orders to buy and sell currencies for a fee, but do not take a position themselves. And lastly, central banks. They sometimes intervene in the foreign exchange market and attempt to influence the price of its currency against that of a major trading partner or a country that it fixes its currency against.
6, numbers 1 and 2. First one, give the definition of arbitrage. Arbitrage is the act of simultaneously buying and selling the same or equivalent assets or commodities for the purpose of making certain guaranteed profits. And number 2 was discuss the implications of the interest rate parity for the exchange rate determination. So the answer is, assuming that the foreign exchange rate is roughly an unbiased predictor of the future spot rate, IRP can be written as this equation here. So the exchange rate is thus determined by the relative interest rates in the expected future spot rate, conditional on all of the available information, IT, as of the present time. One thus can say that expectation is self-fulfilling, since the information set will be continuously updated as news hits the market. The exchange rate will exhibit a highly dynamic random behavior.
Thank you. So interest rate differentials are extremely, important in determining exchange rates. What is if I was going to calculate the risk-free rate differentials, the risk-free rate, what equation would I use to calculate the nominal interest rate on the risk-free rate between two countries? What interest rate equation would I use to calculate the risk-free rate?
Is it the Fisher equation?
Fisher equation, thank you. And what is the Fisher equation? Can you look it up on the computer? Can you look it up in your book? Can you look it up? Did you tattoo it on your ankle, like I asked you to last semester or 2 years ago?
As the IN equals the RR with the bar over it.
Yeah, what's the RR?
That is the rate of.
What is it? Everybody should know this. No, that's capital budget. What's the RR?
Risk-free rate?
The risk-free rate is the nominal rate. So the nominal interest rate, risk-free rate equals the real rate. And what else? What? Nope. Yep. Inflation or inflation expectations?
Inflation expectation.
Okay, excellent. Okay, you need to memorize that. Let's do a little test. What's CAPM? How do you calculate the cost of equity? How do you calculate the expected return on the equity? You gotta know this stuff. They're gonna ask you these questions. You go through finance, you spend 2 years studying finance, you don't know Fisher equation or CAPM, and they ask you, you're out. What is it? What's the CAPM?
RF plus
No, what's RF?
risk-free
Risk-free
rate
rate?
plus
plus-
the expected return
No.
minus the risk rate.
No. Come on, you guys.
Oh, we're expected return in the market minus the risk rate.
Okay, so you're telling me it's the risk-free rate plus the return on the market minus the risk-free rate, is that correct?
The premium.
Times the beta, okay. And if you're doing global expected returns on the cost of equity, or the expected returns on the expected returns on the global equity, what kind of data would you use? Would you be running the regression on to get the beta? Yeah, you would be using the global stock benchmark. Exactly. Okay. All right. You guys need to write this stuff down because I'm going to ask you these questions all the time. And later on, we're going to go through and we're going to calculate, a global weighted average cost of capital based on the global operations of the multinational. Then you're going to use that global weighted average cost of capital to be able to do the discount. Use as a discount rate to do the discounted cash flows to calculate the present values, net present values, and internal rates of return on an exchange-based basis. So it's all the same models, you just got to adjust it and start thinking globally. So thank you for that. Who do we have next? If I'm calculating until you get up there, if I'm calculating the total rate of return on a stock, do I take into consideration when I'm calculating the total return, the change rate and the exchange rates? If I'm calculating the return on a stock that I bought globally in Brazil, am I also going to be taking into consideration the depreciation, appreciation of the currency when calculating the total return on that investment?
Yes.
Okay, next, thank you.
Okay, so I have chapter 5, questions 4 and 5, and the first one is how are foreign exchange transactions between international banks settled? So basically, let's say you have a US buyer who wants to get something from a Dutch exporter. So what they're gonna do is they're gonna go to the US bank and find out the exchange rate. And after they accept the exchange rate, they're going to give them the money. These two banks are also communicating during this process, and they have to debit the appropriate accounts. And then the Dutch bank will credit the account of the exporter, and that essentially is movement of money from the US buyer to the Dutch exporter. And then the second one is what is meant by a currency trading at a discount or at a premium in a forward market. So the forward market involves contracting today for the future purchase or sale of foreign exchange. The forward price may be the same at the spot price, but it usually is higher at a premium or lower at a discount than the spot price. And pricing is interest rate based. So in the interest rate of forwards, the price is based on the yield curve of maturity.
Do you have the quiz? Did I give you these quizzes? Do you guys have these quizzes? Yeah. I didn't hand out the quizzes. Really? Are you sure? I thought I did. Yeah, I think I already did. You guys pull those out so that when we're going through the different problems, yeah, go over this with you and take some notes. I think I have some extra copies up there if you want to grab them. Hold on. I didn't mean to cut you off. I'm trying to multitask here. So. I always like to do at least 5 things at one time. Okay, so if you have the copies, I have some extra copies. Pull out your copies so I can go through them. And action.
Okay. I have chapter 5, question 6. First was why does most interbank currency trading worldwide involve the US dollar? It says that trading currencies worldwide is against a common currency, which is referring to the US dollar, and it's been that since the end of World War II, because it has an international appeal. And but it says, however, the euro and Japanese yen are starting to be a lot more common and used a lot more as international currencies in the recent years. And also, more importantly, that trading would be exceedingly difficult to manage if each trader made a market against all other currencies. And then question 7 said that banks find it necessary to accommodate their clients' needs to buy or sell forward in many instances for hedging purposes. How can the bank eliminate the currency exposure it has created for itself by accommodating a client's forward transaction? And then the answer says that swap transactions, which are simultaneous sales or purchases of spot foreign exchange against a forward purchase or sale of an approximately equal amount of the foreign currency, they provide a means for the bank to mitigate the currency exposure in a forward trade. And then it gives an example of, like it says, to illustrate if like a bank customer wants to buy dollars 3 months forward against British pound sterling, the bank will handle that for its customer and then neutralize the exchange rate risk in the trade by selling borrowed British pound sterling spot against dollars, and then the bank will lend the dollars for 3 months until they're needed, and then they are needed to deliver against the dollars it has sold forward, and then that will be used to liquidate the sterling loan.
Thank you. So if I'm forecasting, first question, if I'm forecasting exchange rate valuations, either up or down, doesn't matter what currency, and I'm building a regression model, what would be some of the variables that would be in the regression model? What would you use to forecast if the dollar was going to appreciate or depreciate against the pound? I wouldn't use the spot currency, but I'm looking at economic factors that would drive currency values. Definitely exports or net exports would definitely be one of them. And, what? GDP growth rate would be a great factor. Foreign direct investment, the capital inflows would be another good one. What else?
Interest rates?
Definitely interest rate differentials. What else? Inflation rate differentials, definitely. Okay, great. You guys are awesome.
So I had chapter 5, CFA 10, which asks, over the past 5 years, the exchange rate between the British pound and the US dollar has changed from 190 to 145. Would you agree that over a 5-year period, British goods have become cheaper for buyers in the United States? So since the value of the British pound has depreciated relative to the dollar has appreciated relative to the British pound, and the dollars needed by Americans to purchase British goods has decreased, thus the statement is correct. I also had problem set 1, which asks, using the American term quotes from Exhibit 5.5, which is just like an exhibit that shows exchange rates for American currency, calculate a cross matrix for the euro, Swiss franc, Japanese yen, and British pound, so that the resulting triangular matrix is similar to the portion above the diagonal in British. In Exhibit 5.6, which is just another exchange rate chart. So the cross rate formula we use is S times J over K equals S dollar over K divided by S dollar over J, where SJK is just the spot rate for currency K in terms of currency J. And so the resulting triangular matrix has 10 elements, like so, where the euro is 123.4 yen, 1.106 Swiss francs, 0.6861 pounds, $0.134, and so on.
Great, thank you. Question B for the exam. I'm asking about yield curves for Japan, Germany, and the United States. And you're going to look at the current 5 years ago and the 10 years, so you have to plot out who's got chapter 5 problem. So what you're going to need to do is sit down and do the research and then plot out the yield curve, the current yield curve 5 years ago and 10 years ago, and look at the movements in the yield curves. It's really, and then you're going to need to calculate the differential between the U.S. interest rates against the Japan and Germany interest rates, so you can look at the differentials. Because the German and the Japanese yield curves went negative on the short end of the curves. They implemented negative interest rate policy. We implemented zero interest rate policy. So we've always had differentials between other countries, particularly these countries. And if our interest rates are significantly higher than their interest rates, capital is going to flow out of their economies and into our economy and prop up the dollar. So I want you to look at that. And then what are the overall trends? Describe the overall trends in the yield curves. Are they shifting up, flattening, inverting? That's really going to be important right now because there are some inversions occurring on a global basis. And obviously our curve is flattened. And then looking at the differences between short and long-term interest rates, and then being able to calculate, if you can, the real rate and the inflation expectations. So you just need to understand the Fisher equation and how to rearrange it to be able to calculate the real rate and the inflation expectations. Okay, and come up with some of those. And those are some of the key factors that are driving capital flows on a global basis. Thank you very much. Sorry, I didn't mean to interrupt you.
Okay, so I have chapter 5, number 9, which asks, given the following information, what are the New Zealand dollar and the Singapore dollar currency against current bid quotations? And so it just gives this information right here in both American and Euro terms, both the bid and the ask. For the New Zealand dollar and the Singapore dollar, and according to the text, the SB is equal to the New Zealand dollar over the Singapore dollar, which is the dollar over the Singapore dollar times the New Zealand dollar over the dollar, which is going to be equal to 0.6135 times the 1.3751, which is going to give you 8.436. And so the reciprocal, the 1 over this value, you would calculate 2 being 0.641 times the 1.3765 over there, which would give you 0.8452. And then, so the New Zealand to Singapore dollar bid ask spread would be, it's kind of hard to see it like down here. It's going to be New Zealand dollar 0.8436 to New Zealand dollar 0.8452. And the Singapore to New Zealand dollar spread would be Singapore dollar 1.182 to Singapore dollar 1.1854.
So the next question is about the stock markets. Again, what I would do is I would pick the stock markets and then print out the 3 to 5 year charts on the computer and then come in and answer these. Go ahead.
Alright, so this one was from chapter 4 about Parmalat is a company similar to Enron that had a similar cooking the book scenario. So the first question was regarding how it was possible for the Parliament managers to cook the books and hide it for so long. And so they were able to do this due to Italy's low level of accounting transparency. So then the next part of the question was investigating the role that international banks and auditors might have played in their collapse. And the role they might have had was not conducting the full due diligence that was needed to be able to ensure this collapse not happening. And then also the third part of this problem was studying and discussing Italy's corporate governance regime and that kind of role that it might have had in this collapse. And so their corporate governance regime is pretty weak. They don't have strong investor protection, so for like outside shareholders, it's not very strong. And so public firms are primarily dominated by large controlling shareholders, sometimes founding families that are involved with the businesses. And so there was a lack of independent board directors as well contributing to this failure.
Thanks, Ed. So the stock market, who's going next? And then the stock market indexes, I want you to conduct the technical analysis on. It's going to be Tokyo, London, and the U.S. And the key to this technical analysis is not only momentum trading, technical trading, but also are there similarities or correlations between the three global stock markets? Does one lead? Does one lag? Is it coincident? Are they correlated? Are they low correlation, high correlation, inversely correlated? So conducting the analysis.
Alright, so I had chapter 5, question 10. And basically, it gives you some quotes for currency conversions, and you want to see if there's an arbitrage opportunity and how much. So Swiss franc is 1.597 francs per dollar. Australian dollar is 1.825 Australian dollars per dollar, and the conversion rate between Australian dollars to Swiss francs is 1.440 Australian dollars per Swiss franc. So basically, first you want to calculate the implicit conversion rate between Australian dollars and francs, which is just multiplying the quoted rates to get you 1.1405 Australian dollars per Swiss franc. And this tells you that there's an arbitrage opportunity since the Swiss franc is overvalued relative to the Australian dollar. So then your next step is that you want to sell the Swiss francs to buy Australian dollars using just the direct cross rates. And so you have $1 million US, which you can then convert to 1.5971 million Swiss francs. You take those francs that you get, convert those to Australian dollars, again using the conversion rate given, and then those Australian dollars you convert back into US dollars for a profit of $3,064.73.
Nice job. That's great. And then the next question on the exam is on old oil and gold. I would be looking at oil from the Middle East perspective, Brent crude prices. Look at OPEC as a driver. Look at China as a driver, U.S. as a driver. And when you're looking at gold, gold is in extremely high demand in India and China as it's used culturally there. And I would look at also central bank gold reserves. Those are the two areas that I think are extremely important for gold, along with geopolitical risk and inflation expectation hedges and devaluation hedges for their currencies.
I had chapter 5, question 2. Using the American term quotes from exhibit 5.4, calculate the 1, 3, and 6 month forward cross exchange rates between the Australian dollar and the Swiss franc. State the forward cross rate in Australian terms. So there are two formulas that you can use. I chose the European term, and there's an American term and a European term to do it, and this is like the European way. But these are, so the equation is whatever, N means like the number of months, and then it's the Australian dollar against the US dollar, and then divided by the Swiss franc dollar against the US dollar. And I found, like in the reading, that if, like on this side is the Australian dollar, and as it increases, it means that in European terms, that the Australian dollar depreciates against the dollar, and on Swiss francs terms, that the Swiss franc appreciates against the dollar. And these are the Australian terms. Thank you.
Great, excellent. And then for the foreign currency question, I'm going to want you to print out the 3-year charts for the dollar, yen, pound, and euro, and conduct the fundamental and technical analysis of what's driving those currencies, and look for cross correlations amongst the currencies too. I try to identify global systematic risk that's driving the currencies up and down.
I had chapter 5, questions 1 and 2. Question 1 asks for a kind of broad definition for exactly what the market for foreign exchange is. And so it can be broadly defined as the market that encompasses the conversion of purchasing power from one currency into another, bank deposits from a currency, the extension of credit denominated in a foreign currency, foreign trade financing, and trading in foreign currency options and futures contracts. The second question asks for the difference between the retail and client market and the wholesale and bank market for the foreign exchange. So basically you can see the foreign exchange market has a 2-tier market, with one tier being the prior retail client market and the other tier being the wholesale or interbank market. International banks provide the core of the FX market. They stand willing to buy or sell foreign currency for their own accounts. These banks serve the retail clients, corporations, or individuals, and they make up for about 86% of the foreign exchange market, with the retail slash the client market making up for only 14% of the market.
The next question on the exam on page 3 is the supply demand analysis for foreign currency. This is the US dollar to foreign currency. So what would shift the supply curve back? What would shift the supply curve out? What would shift the demand curve up? And what would shift the demand curve down? And I'll go over those with you, but we've already gone through some of that stuff. Go ahead.
So question 3 of chapter 5. The question is, a foreign exchange trader with a U.S. bank took a short position of 5 million euros or pounds. The rate was $1.55 to pounds, and then it changed to 1.65. Is the rate's movement good or bad for the trader? And then it asks for the change in the bank's liability. So you take the 5 million pounds and you multiply it by the rate, which is 1.55, you get $7,750. So that's the original bank's liability. And then after it changes to 1.61, the bank's liability changes to $8,050,000. So it increases the liability $300,000, and the pound's appreciation hurt the trader since he went short.
Great, nice job. And then the second question is on balance of payments. You're going to need to go to the Organization for Economic Cooperation and Development, or the OECD. You may be able to get it from the World Trade Organization and the International Monetary Fund to get the balance of payments. And your analysis will be to look at the balance of payments for these different countries that are running current account surpluses, such as China, Japan, Saudi Arabia, Germany, and the United States. What you want to do is you want to look at the current account balances against the currency charts and see if there's a correlation between surpluses and current account deficits and the currency appreciation or depreciation rates. Theoretically, if you're running a surplus, the currency should appreciate. If you're running a deficit, your currency should depreciate. The question is that true? And then you test for that hypothesis. Go ahead.
So
This is chapter 5, question 4, and it's restate the following 1, 3, and 6 month outright forward European term bid ask quotes and forward points. So the spot is the base rate. When the rates are higher than the spot, then it's a forward premium, and these are all premiums. And when we look at the forward and restate it, in 1 month it's 1 to 6, 3 months it's 17 to 27, 6 months it's 57 to 72.
And then the next question is global modern and postmodern portfolio theory. Let me just do a little bit before because we're almost done. When you're building global portfolios, either you're building global portfolios of stocks, bonds, real estate, or stocks, bonds, and real estate. Stocks, bonds, real estate, and insurance products. Stocks, bonds, real estate, insurance products, and real estate. Stocks, bonds, insurance products, real estate, and alternative energy assets. Stocks, bonds, real estate, alternative assets, insurance products. The last one is currencies. You may want to hold currencies within your portfolio. So I look at it more from a multi-asset portfolio standpoint. Why would I add global real estate and global insurance and global renewable energy and global currencies to my portfolio? Why would I add that? Why would I add those alternative assets to the portfolio? What's it going to do to the expected return? It might raise it. Exactly. So what's it really going to do? What's really going to, by adding these alternative assets in the mixed asset global portfolio, what's it going to do to the portfolio standard deviation? It's going to cause it to fall significantly. So what happens to the risk-adjusted rate of return when you build a global portfolio? It goes up. Okay? That's why you do global diversification. And you can actually get negative betas on some of your portfolios if you construct them correctly. You can't do that domestically. Okay? So we'll go through that. How could I bow out the efficient frontier synthetically in a global portfolio? What tools would I use to bow out the efficient frontier? When I add these alternative assets and I go global, it bows out the efficient frontier. So it increases the risk-adjusted rate of return. How could I do that synthetically? How could I bow out the efficient frontier? What tools would I use to hedge off market risk on a global basis? I would use derivatives. And what would I do? I could use swap contracts. I could use what kind of derivatives? What kind of other derivatives? If I think that the global returns on my portfolio are going to go down in the future because of global recession, what would I be doing? I'd be doing credit default swaps. Okay, I would use swaps. What other contracts would I use? In your memos, you memorized it. If the values are going down and the total returns are going down, what am I doing?
Puts and calls.
Would I be buying puts or writing puts? Buying puts or writing puts? Buying puts or writing puts? I would be buying puts. Would I be buying or writing call options? I would be writing call options. What would I do on futures contracts? Would I be buying futures or writing futures? Writing futures. What about forward contracts? Would I be writing them or buying them? I would be writing or buying. Writing or buying? You would be writing forward contracts. Okay? So that's basically what that question is. Okay, who's next? Thank you.
So I had chapter 5, question 5, and it builds off question 4. So using the spot and outright forward quotes and prompt 4, determine the corresponding bid-ask spreads and points. So for this spot, it would be 5. For the 1 month, it would be 10. For the 3 month, it would be 15, and the 6 month, it would be 20.
And then on that global portfolio question, it asks you what the effect on the capital allocation line what would be the effect on the capital allocation line if the risk-free rates went negative? What would happen to your expected return on the portfolio if risk-free rates went negative? Using the capital asset pricing model equation also. If your risk-free rates, right, the origin, right, portfolio standard deviation, expected return on the portfolio, positive risk-free rates. What happens to the expected return when the capital allocation line and the risk-free rates go negative? What happens to the expected return on the portfolio?
It goes down.
It goes down, exactly, okay. And then the last one, the last question is on derivative trades. So if you think that the value, global currencies, stocks, bonds, real estate are gonna go up, and you have indices that measure that, what would be your trades if you think the values are gonna go up? How would you trade? What would be your derivative trades if you thought that the indices were gonna go up? What would be your trades on the indices? We just talked about it like 2 seconds ago.
Buy forwards and futures.
You buy forwards and futures. What about the puts and the calls on the futures? What would be your trade? You would buy calls, right puts, excellent. And what about global exchange traded funds that are in your portfolio? You thought that the values and the prices were gonna go up. What would be your ETF and your stock trades? You what? Yeah, I would buy them, but I want to leverage. How would I buy the ETFs and the stocks? I'd buy them on margin, and what about the option contracts? What would be the trades on the options? Would I buy or write puts and calls if I think the values are gonna go up? You memorize this, you wrote 5 of those, I took it in 15 times. I buy calls or puts, got it. And then what if I think that the value of my ETFs, my stocks, my bonds, my real estate are gonna go down in the future, and I wanna hedge off global market risk in those asset classes. And I got, the indexes actually track the value of my portfolio. What would be my index trades to hedge off and apply portfolio insurance to the portfolio? What would be my index trades? What would be my derivative trades on the indexes? We just talked about it, we just said it. No, that's things going up, this is things going down.
Buy forwards?
No, I wouldn't buy forwards.
Or right?
I would write. Take me through the trades.
Right forwards, right futures, right calls on futures, buy puts on futures.
Perfect, okay, and then if I thought my ETF and my stock prices, global stocks and my global ETFs prices were gonna go down, what would be my trades on the stocks and the ETFs? Sell short, right calls, right calls and, got it, okay? I'm gonna test you guys over and over and over again, so you got it down, okay?